The S&P 500 continues its tear in 2025, now up nearly 16% with a lot of sectors particularly in the green. And in the midst of all this, members of Congress continue to load up on stocks. And two of these purchases I think are particularly interesting because they operate in sectors that are heavily regulated by the government. Now, if we look at the US government tracker on forecaster.biz, which by the way, there's a link to in the description, be sure to check them out, you can see we had 4 quarters in a row when there was more Congress selling than buying, but in Q3, that was not the case. We finally saw more buying than selling. So where were members of Congress pushing their capital to? Well, one of the primary stocks was JP Morgan Chase, and complete transparency, like always, this is a position I own in my personal portfolio, and I'm currently up close to around 186%. Now, if we look at JP Morgan Chase in the last 5 years, they're up by 197%. Last 3 years, 145%, and in the last year, 35.32%. Now, one of the things that I like about this website, Forecaster, is you can overlay things like sales with the share price, and what do we know over the long term? Well, Benjamin Graham taught us that fundamental growth is what drives long-term share price appreciation. To put it in as plain English as possible, the more money that a business makes, the more the share price will go up over time. And we can see that's been the exact case with JP Morgan. Look at net income charted out over the share price in the last 5 years. As net income grew, so did the share price. When it dropped, so did the share price. And as it's grown at a high rate over the last few years, the share price has followed. Along with this, they've continually grown those dividend payments. In fact, if we take a closer look at this, we can see they've been increasing the amount they pay out in dividends every 2 quarters for around the last year now. It's extremely rare we see that. In the summer of 2023, they were paying out $1 per share, and now they're paying out $1.50 per share. So a 50% increase in the amount they're paying out in dividends in just around 2 years. Now, JP Morgan being on this list is interesting for 2 reasons. Number one, the Fed just started a rate cut cycle. We can see on September 17th, they cut rates for the first time in over a year. And the odds market is currently showing around a 97% chance that they do so again in just a few days, on October 29th. Now, this is really important to make note of as we think about JP Morgan and their business model. JP Morgan is a bank, and on the most basic level, what do banks do? They take in deposits and they give out loans. Now, the loans that they give out at fixed interest rates aren't going to be impacted by changes in the federal funds target rate. But the loans that they give out at variable interest rates will undoubtedly be impacted by this. And so with rates dropping and with them being projected to continue to drop, what's the end result for JP Morgan? Well, it means their net interest income is going to drop, at least in the short term. Now, we have to remember, net interest income is one of the key metrics for bank stocks. So you might be thinking that higher interest rates are typically great for bank stocks, but that's not necessarily always the case. Let me show you what I mean. If we jump over to the company's Form 10-K, if you read these documents, you'll know more about the business than probably 99% of Wall Street analysts, but you can see they are long, 436 pages. But one of the best areas to look is if we scroll down, we can see the index. Read the company's risk factors. And on page 20, they talk about how interest rates impact the business. And they state, higher interest rates can also negatively affect the payment performance on loans within JP Morgan Chase's consumer and wholesale loan portfolios that are linked to variable interest rates. If borrowers or variable rate loans are unable to afford higher interest payments, those borrowers may reduce or stop making payments altogether. So really, it's a two-way street when it comes to lowering interest rates as it relates to bank stocks like JP Morgan. Yes, in the short term, it might lower net interest income, but in the long term, it can spur more economic growth, causing more people to take out loans, therefore generating more net interest income for JP Morgan. So personally, I'm of the belief that over the long term, lowering interest rates is even good for bank stocks. Now, on top of this, I recently ran across a clip from Tom Lee, who stated he's quite bullish on bank stocks and JP Morgan in particular, and I'm going to go ahead and play the clip as to why that is.
I was saying this last week. Tom, are you getting bored of the market?
I mean, I think
bored.
there's a lot of clues coming, that there's some really big things happening. Like, I think one of the
Clues coming for what?
I think that one of the most interesting things is that the U.S. financial system is about to get really re-architected in a way that's like oil. Like, imagine oil had all of these E&Ps and stuff. But the one difference is that the financial system could become like as big as the tech sector in terms of market cap.
Really?
Like JP Morgan's PE could become a growth stock.
If what?
Well, if they become less reliant on two things. One is like the traditional financial architecture has a lot of friction, right? Because there's so many intermediaries in everything that's done, including like how JP Morgan.
But Tom, aren't they the friction?
Yeah, why do they want to remove it? That's their rake.
Well, but if they could make more rake. So remember, there's like power laws. Like as soon as the banks get involved in an industry, they already have a large share. So they have the ability to do power law in anything they do. And so like if they decide to go into like re-architecting the bank, one of their biggest sort of saves or value capture is the staffing of the industry could drop a lot. You know, JP Morgan has 200,000 people, you know, they could make more money with 5,000. So I think that the financial industry could start to be trading like a tech sector multiple.
Oh, I like that.
That's a call.
Right? So that's very exciting.
As a long in JP Morgan, I'm into
so
it.
Goldman, like JP Morgan and Goldman and Morgan Stanley, they're going to be strong, whatever they do, because they have customer relationships that will follow them to whatever they do.
So the metric for banks was tangible book. That's like what they always say on TV, and that's not the metric anymore.
Correct. It might be. And even things like credit cost and net interest margin, it's going to change as a dynamic because like if JP Morgan gets big in stable coins, they might make more money from stable coins than deposits. You know, like they may be a very different company.
If it's not out of the question to see a re-rating like that because we're living through one in the utilities right now.
Exactly.
So it happens.
So suddenly power's become a really important driver because of AI. Yeah. Well, AI is converging onto the blockchain to create a crypto token economy. So the financial system is always the other side of that. Like so if there's a big AI story for tech, there's got to be a big crypto story for financials.
Yeah.
And that's why suddenly financials could become a huge percentage of the S&P.
Okay, so that's a pretty shocking statement from Tom Lee. He thinks bank stocks have the potential to be valued like tech stocks in the future. Now, keep in mind, we typically value bank stocks based on multiples like the price to tangible book value. But if we see a shift in the way that JP Morgan operates like Tom Lee stated, they'd probably be valued more based on the price to earnings multiple, which right now is only sitting at about 14.7. So in the future, if they did start to be valued like tech stocks, this multiple would expand considerably. And if they got to a PE multiple of about 21, then essentially that means the stock would grow by about 50% without even accounting for earnings growth. Now, obviously that's coming from Tom Lee, who is extraordinary bullish, but I do think it's a perspective we should keep in mind as we analyze these stocks. Now, on top of this, JP Morgan does have a decent starting dividend yield around 1.84%, and on a forward-looking basis, it's probably closer to around 2%. But again, we have to keep in mind the dividend's grown by over 50% total just in the last couple of years. So yes, JP Morgan is up significantly in the last 3 years, but we continue to see members of Congress buy. And keep in mind, they're in a highly regulated sector. A sector that obviously members of Congress would have a huge advantage in. The next stock we're going to be looking at was actually one of the most frequently bought stocks by members of Congress in Q3, and it's one that's been in the news a lot lately, United Health Group. What a ride United Health Group has been on in the last year. Over the past 5 and 10 years, the company has seen tremendous growth from a fundamental and share price appreciation standpoint, but if we look at just the last year, they're currently down by about 35%. We can see in a matter of about a month, they went from close to $600 per share all the way down to around $274 per share. And then about a month later, we saw them all the way down to close to $240. Now, since then, we can see the recovery has started. They're currently trading close to around $360 per share, but that's still significantly lower than where we previously saw them. And if we look at the price to earnings multiple overlaid over the last 5 years, we can see, yes, the share price has declined, but the valuation has declined as well because the fundamentals remain relatively high. There was a drop in earnings in 2024, and that was due to the one-time cybersecurity cost. But if we look at earnings projections through the year 2029, one of the things you'll see is based on the average analyst estimate, the projected EPS CAGR for UNH is around 17% from 2025 through 2029. So we're talking about significant earnings growth projected over the next 5 years. And typically when that's the case for stocks, we'll see a high price to earnings multiple because earnings are projected to grow at a high rate. But that's not currently the case for UNH. We can see historically that PE multiple has been in the range of around 20 to 25, and it climbed a little bit higher in late 2024. But right now, that price to earnings multiple is sitting right around 15. In fact, if we jump over to the fundamentals tab, you can see 15.22 is the price to earnings multiple on a trailing 12 months basis, and on top of this, the yield is currently sitting at about 2.38%. Now, if you've been keeping up with the company, you know the obvious reason that we saw this sell-off. It's due to the DOJ investigation. Now, so far, we haven't heard that the DOJ has found anything. And on top of this, in Q3, quite a few things happened that I think really changed investor sentiment, which is why we saw the stock climb from 240 all the way up to around 360. And the first one was, yes, members of Congress were buying, as we already know. But it wasn't just members of Congress buying, it was United Health Group insiders buying as well. Here's the total amount of insider buying in 2025 we've seen from UNH so far. Compare this to the previous years. It blows them out of the water. So members of Congress are buying and United Health Group members are buying. And every 3 months over on Dividendology.com, I put out a report on the stocks that super investors have been buying, which are basically investors with over 100 million in assets under management. And guess what stock was the most bought stock by super investors in the most recent quarter? Again, it was United Health Group. And one of those super investors that added it to his portfolio was none other than Warren Buffett, Berkshire Hathaway. We can see he initiated a new position where he bought over 5 million shares. So when you add up the Buffett buys, when you add up the super investor buys, the insider buys, as well as members of Congress buying, I think it started to give retail a little more confidence in this company. So what do returns look like moving forward for United Health Group? And real quick, let me mention, their earnings report is coming up in just the next few days, and I would certainly expect a lot of volatility one way or the other. Whenever we talk about a company's potential returns, we always need to look at it through the lens of sources of returns. And what we're looking at here is the sources of returns for the S&P 500 by decade. Notice the three sources. We have the dividends paid out, we have earnings growth, and we have multiple change. This will always add up to equal what the total return actually was. So here's what we know for United Health Group. Right now, the starting dividend yield is about 2.38%. That would be one of your sources of returns. The projected EPS CAGR through the year 2029 is above 17%. Again, one of your potential sources of returns. So that just leaves us with multiple change. Now, again, this is essentially saying how is the price to earnings multiple going to change? And when we look at the price to earnings multiple overlaid here on Forecaster, look at it over maybe the last 10 years, you can see this is the lowest PE multiple in literally over a decade. Now, the caveat is, yes, if the DOJ does find something, then the price to earnings multiple could certainly go lower. It could hinder future earnings growth. There could be fines. There's absolutely risk here. But if they don't, on top of earnings growing at a high rate, on top of the dividend, we'll also likely see multiple expansion, with the PE multiple reverting back to its average, which is around 2021. So looking at the sensitivity analysis model, even without accounting for dividends, assuming the average EPS growth rate from analysts, and a PE multiple that's still a little bit lower than on average over the last decade, you can still see through the year 2030, you're getting a total return of near 100%, which also does not account for dividends, so in reality, it'd be quite a bit higher. So in my opinion, it's easy to see why members of Congress were interested in these two companies. And to be quite frank, these are probably companies that they might have a little extra information on. Again, don't let anyone guide your investment decisions. You have to come to your own conclusions. But this is absolutely something worth making note of. Again, be sure to check out Forecaster at the link in the description. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.